When we hear about China committing to reach carbon neutrality by 2060, or that India pledges to do the same by 2070, you might be asking yourself, how are these countries possibly going to make that happen? China and India are already the first and third largest carbon emitting countries on the planet, respectively, and they're still developing economies. Well, one of the possible methods they can utilize is establishing compliance carbon markets, also known as emissions trading systems or cap and trade schemes. So there are quite a few different names for them. But in this video, we'll discuss what compliance carbon markets are, how they operate, as well as the differences between the most popular and investable carbon markets around the world. So, a compliance carbon market is a market created by a government of a particular country or group of countries to put a cap on national carbon emissions. This cap is the maximum amount of carbon dioxide the area will allow to be emitted by market participants per year, and that cap is continually reduced every year. For example, the carbon emissions cap for the European Union's emissions trading system was around 1.5 billion tons in 2021, or 1.5 gigatons. Each individual ton within that cap is represented by a carbon allowance. A carbon allowance is a permit from the government to emit 1 ton of CO2. And the market aspect comes into play because these carbon allowances can be traded between different market participants. So if one company reduces their emissions, then they can take the extra allowances that they were allotted and sell them into the market for other companies to buy, so another company can meet their quota as well. And it's worth noting that there's a possibility a company can use carbon offsets from the voluntary carbon markets for a certain percentage of their obligation. For example, in the California emissions trading system, an emitter can use carbon offsets for up to 8% of their quota. So these can't be used for the majority of a company's carbon footprint, but it can be used for a small percentage if needed. Which industries are required to participate in the compliance markets can also vary by country or individual system. In the EU, their system covers a variety of industries like power plants, aluminum or petrochemical companies, and more. But under the Regional Greenhouse Gas Initiative, or RGGI by contrast, it's just power plants in that region. So we've mentioned some of the markets in passing, but the major investable compliance markets are the EU, California, which includes Quebec as well, the RGGI, which takes up a large portion of the Northeast in the United States, and then there's also the United Kingdom as well. Those 4 markets are investable for the average retail investor. As far as some of the other large and emerging markets, China is one of the largest, and India might be developing their own carbon market soon as well. So there are markets popping up around the globe. As there are a variety of different markets globally, all these countries have different climate goals, and this means varying carbon caps at what rate they will decrease over time. For example, the EU will decrease the cap of allowable emissions by 2.2% every year. In the Californian system, the cap is decreasing by a more aggressive 4% on an annual basis. The United Kingdom system was just established relatively recently, but that system brought the supply of allowances down by around 2.5% last year. So it all just changes based on what emissions goals the system is trying to meet. Speaking of allowances, you might be wondering how they're given out to market participants. Well, this is typically done in 2 ways. The system will either hand them out for free, which they will do for a certain period of time if they don't want to drive away a particular industry from the country. If the cost of reducing emissions is too high, then they'll just move out of the country if one of these systems tries to cut emissions too quickly. The other option is through auctions, which serve several purposes. The first is giving out allowances to market participants, of course, but they also serve as a pricing signal to the market. They tell all the industry players around what price the allowance is settled at, so there's a decent pricing mechanism there. And finally, the money paid for those allowances is taken by the compliance market and used to fund various projects. Those funds will likely be used to help the environment in some way. The EU system has the Innovation and Modernization Funds, which are used to bankroll the transition to green energy and reducing emissions in the EU. The Californian system has the Greenhouse Gas Reduction Fund, which is used for a similar concept, as well as using 35% of the revenues to directly help environmentally disadvantaged or low-income communities. So all the funds raised in these systems aren't just going back to the government, they're actually being used to fund useful projects. The last process worth mentioning across these markets is some type of reserve that stores or releases credits to avoid too much pricing volatility. So the EU has the Market Stability Reserve, which has been used to try to help reduce the glut of EU allowances available in the market. So most of the compliance markets will have some form of reserve like this. In closing, it's worth mentioning the difference in size of compliance markets versus voluntary markets. The EU market was valued as highly as around 900 billion last year, and the Californian market was around 20 billion as of 2022. So these markets dwarf the size of the voluntary carbon markets, which in total, around the globe, are valued at around $2 billion. And personally, I think that's where the best potential investment upside can be found. But if you'd like to learn more about possible investment options in both the compliance and voluntary markets, as well as how voluntary carbon markets work, I'll link to both of those videos in the description below. Thanks for watching.